As you transition from business owner to retiree, your biggest fear is probably a big drop in the stock market right after you retire. Now, if you set up your retirement portfolio correctly, drawdowns in the market actually help you in the long run. Now, they really suck. We're in the middle of it. It's never fun. It feels like the end of the world. But if you have good advisors around you, your retirement will be better and stronger because of that market correction than as if it had never happened. Now, the first step is to make sure that you do hire a qualified professional to help you set up your retirement portfolio. One of the easiest ways to identify these people is someone that has a CFP designation, certified financial planner, or a CFA designation, chartered financial analyst. Now, the CFPs, they're more based on kind of personal finance topics, and the CFA is more focused on investment topics. Now, that doesn't mean there aren't very good, well-qualified advisors without those designations. It's just easier to sort through the crowd if you pick people who have that. Now, your advisor should set you up in a portfolio that's a combination of stocks and bonds based off your age and your risk tolerance, exactly how much of each you own, but there should be some type of blend. I'll just say a quick note: stay away from insurance agents pretending to be advisors. If they work for an insurance company and their plan is to sell you a crappy, expensive annuity, that's typically not what a true advisor does. Typically, advisors build portfolios with a blend of stocks and bonds. And you have to watch out because this app is filled with insurance salespeople pretending to be financial advisors. So now, if you have a mix of stocks and bonds, when the stock market goes down, your stocks are going to go down in value. But traditionally, bonds actually go up in value when stocks go down. Not always, but usually they stay more steady, or if they do go down, it's not going to be as much as the stocks went down. So the beauty of that is, say, if you have a portfolio that is set to be 60% stocks and 40% bonds, which is a very common portfolio for a retired person, and the market goes down, that 60% of stocks, as the stocks shrink, becomes a smaller number. So now, let's say your stocks are 55%. So that gives the opportunity to rebalance your portfolio. So you sell some bonds and buy some stocks, and you bring it back up to that 60%, and then you participate more on the upside than you did on the downside, meaning you were better off that downturn happened versus if the market had gone just straight up. And of course, the other side of the coin is that when the market's up high, that's the opportunity where your stocks that were supposed to be 60% are now 65%. So your advisor could sell some stocks, take you back down to the 60%, which in a way gets you ready for the next downturn. Because the markets do go down 10% on average every 16 to 18 months, and they go down 20% every 4 to 5 years. And it's just part of a normal market. It's something that you should plan on happening and something you should expect to happen. It's never fun when it does happen because the media is in the business of scaring you. And don't let them scare you out of your retirement. They're going to tell you the end of the world is coming, that things are never going to be the same. I've seen a lot over the last 25 years investing. We saw that Y2K was going to drop planes from the air. We saw that the ATMs were going to run out of money. We saw people are never going to shake hands again. They're never going to go to a buffet, and they're never going to go on a cruise again. Now there's some questioning on whether America is ever going to be the leader in the world that it was. And I'll say these storms, they come and go, and the world looks a lot like it did before the storm came after. You typically see very little change, and you see a lot of Chicken Littles come out and tell you that the world is changing and things are going to be forever changed, when the world really doesn't change that much by the time you get to the end. So if you have a good advisor and you do it right, you shouldn't fear market drawdowns. And if you do, that's something that you want to address in calm markets, not when things look scary. You want to make sure that you have that portfolio that makes it so you can sleep at night. And that's where the bonds come in to give you that ballast, that they can give you current income and offset some of the volatility that you'll see in stocks. But as long as you are set up correctly, these ups and downs of the market are your friend. They're something that you shouldn't be scared of and something that you shouldn't try to avoid. So if you need help prepping your business for sale and getting ready for your ultimate retirement, check out the link in our bio and we can help you prep and sell your business.